Hello and welcome to Future 42. We look forward to sharing our knowledge with you and pray that you receive it in its highest regard. Money. The people will tell you that money is a medium of exchange or an instrument that can be used to facilitate transactions for goods and services. It adds value to your life. But have you ever thought that your paycheck, which is yet to be received exactly 1 month from now, is already decreasing in its value? And the savings you are doing for your old age retirement won't even last, is it worth it today? You should be aware of the fact that as time goes on, money will become less valuable due to a phenomenon known as inflation. In the 1960s, corn prices averaged $1.17 per bushel, and soybean prices averaged $2.70 per bushel. After 2006, corn prices have averaged $4.22 per bushel, and soybean prices have averaged $10 per bushel. Well, that escalated quickly, I guess, right? Most nations strive for inflation rates between 2 and 2.5%, which is nearly 10 times as much. The value of the money you have saved depreciates by this amount yearly, which means that keeping all of your money in a bank account eventually becomes a problem. At this point, the phrase investment is introduced to you. Utilizing your resources to increase your income is one way to combat inflation. What exactly is the stock market? You've certainly heard about it and how it's one of the simplest methods to invest your money. Is it really as profitable as others would have you believe, and how can you even start investing it? Simply said, it is a wise place to stash your money. When you finally connect them, you exclaim, "Damn it, that's what's happening." Simply said, a market is a place where goods are bought and sold. The economies of nations like the United Kingdom, the United States, Japan, Germany, China, and India are heavily dependent on a variety of markets. The stock market impacts the economy because it influences consumer confidence, which ultimately influences the overall economy. The relationship also works the other way, in that economic conditions often impact stock markets. Less is spoken about how the stock market affects GDP than how GDP affects the stock market. Corporate profits rise in response to rising GDP, which is positive for stocks. The stock market affects GDP and the economy overall, albeit indirectly, whether there is a bull market or bear market. The inverse happens when GDP declines, which results in less spending by businesses and consumers, which pushes the market lower. For instance, a fish market deals with buying and selling fish, a clothing market with buying and selling clothes, and a stock market with buying and selling stocks, which begs the question, what exactly is a stock or a share? Both phrases are used synonymously to refer to a par ownership in a business and fundamentally signify the same thing. If firm X had a total of 10 shares, also known as the outstanding shares, and the founder of the company owned each and every one of them. If the founder has 5 shares, they only possess 50, and so on until they own 100 of the company. Now that we frequently refer to those who possess shares in a firm as shareholders, a new question arises. Why would a founder or a business owner choose to sell shares in their own company? Consider for a moment that you were the owner of your own business, a cafe where business has been booming. You run the best cafe in the neighborhood, and sometimes there are lines of customers outside your door, but you have big goals. You want to grow your business because, as you can see, you sincerely believe that your cafe business and the products you manufacture are the greatest in the market, and now you want expansion. To expand your business and open new chains, hire more people, and launch larger marketing efforts, you'll need to raise more finance. Now, you could go to the bank and ask for a loan, but that would require paying interest on the loan, and the bank might even view you as too risky and reject your offer. Therefore, issuing or selling company shares is another way to raise cash for your firm. Either do this privately and sell the shares to a few close friends who support your venture, or do this publicly and sell the shares to everyone who expresses interest. A specific occasion called an IPO would be used to accomplish this. After another prosperous day at the cafe, you decide to conduct an initial public offering, IPO, which turns your private firm into a public one. The amount of shares you offer to the public is generally referred to as the float, and it is one of the decisions you must make when a company decides to go public. Now, the initial value of each share in your firm is determined by the financial health of your business, the health of your competitors' businesses, and the level of demand for your shares when they eventually go public. The shares of publicly traded corporations will then be placed on a stock exchange, among many other variables. In order to better understand this, let's use the example of a local market. There may be many local markets in your city, but you can only choose one of them to set up your food stall. Imagine that they are now termed stock exchanges rather than food marketplaces. They are the real locations where trading takes place, and instead of food stands, a variety of businesses are listed at these stock exchanges. It is up to you to choose the exchange that is most suitable for listing the shares of your firm, and each stock exchange will have its own unique requirements for businesses to list and trade their shares there. The New York Stock Exchange, which was established in 1817, and the NASDAQ, which was established in 1971, are two of the largest exchanges in the United States, and is best known for listing some of the biggest tech companies, including Google, Apple, Amazon, and Intel. However, stock exchanges are found all over the world, not just in America. So, let's discuss brokerage or stockbrokers. A stockbroker enters the picture and buys and sells stocks on the investor's behalf. They work as an intermediary. In the past, brokers would go to a stock exchange's trading floor where they would shout over one another in an effort to meet their clients' requests. However, due to technological advances, this procedure has become highly automated and is now carried out by computational models. Due to the NASDAQ's flawless trading, for instance, the necessity for a physical stock market was substantially diminished. But how does a trade truly take place? Similar to placing an order on Amazon, an investor will first visit a broker and place a share order. However, there are a few additional elements in this arrangement. You must first actually identify the company in which you wish to buy or sell shares in order to assist your broker. In this, a corporation is frequently represented by what is known as a ticker symbol, which is simply a shortened name. A few examples of ticker symbols include AAPL for Apple, AMZN for Amazon, and TSLA for Tesla. A fast Google search will reveal a ticker symbol of any given corporation. The next step is to decide whether you wish to buy or sell shares, after which you may choose the type of order. You see, considering the stock market as an auction market is useful. When a buyer and seller match, the trade is initiated. There are thousands of buyers bidding how much they want to pay for a share, and thousands of sellers asking for a specific price. As the price of a share changes depending on the supply and demand for those shares, this occurs millions of times every day. A market order, for example, instructs your broker to buy or sell that share at the best price currently being offered on the market. A limited order is another sort of order in which, similar to an auction, you specify a reserve price for the shares you want to sell and a highest bid for the shares you want to acquire. This means that you won't sell for less than your reserve price and won't buy for more than your maximum offer. The risk in this situation is obviously that the order won't be filled if the stock never reaches the price you're aiming for. Although there are additional order types, market orders and limit orders are typically regarded as the two most common. You simply tell your broker how many shares you'd want to purchase after indicating your order type, and that's about all. In the past, written mail would have been used to conduct this. Once the telephone was invented, placing orders with your broker over the phone was possible when buying and selling actual physical stock certificates. To the delight of any introverted investor, most brokerages are now online or have apps where you can place an order without actually speaking to a person, and shares have changed from being physical certificates to digital records. The question that remains is how you, the viewer of this video, can use all this information to make the best investment choices. There are many players in the investing game. The terms institutional investors or retail investors are frequently used. People like me or you who invest for their own accounts are referred to as retail investors. However, the term institutional investors refer to the major players in the market, such as banks, hedge funds, mutual funds, pension funds, and so forth, who make substantial investments on behalf of their clients. These organizations frequently employ analysts who carefully research the market and decide which investments are the best to make. However, this video is intended for novice investors like you and I who wish to buy stocks in order to achieve our financial objectives and later sell it for more money, pocketing the difference. In essence, we want to buy low, sell high, and to do so, we need to have a knowledge of which stocks are likely to experience price increases and which ones will experience price decreases. However, how are you supposed to be aware of the fact that the supply and demand for a share heavily influences its price? If tomorrow brings good news about a new product from Apple, we may anticipate a rise in interest in the company's stocks as people's faith in the business develops and they anticipate increased profits from the launch of the product. As a result, the price of Apple stock rises since sellers want to be paid more for their shares and purchasers are willing to pay more for those shares. But this also implies that the stock market is very unpredictable. A variety of factors, such as a new CEO, product quality, a change in government regulations, or even how popular a particular industry is, can affect share prices. The average retail investor finds it challenging to keep up with this on a daily basis, while also working a job or operating a business, which is why long-term investing is typically thought to be preferable to short-term investing for the average retail investor. Purchasing shares and holding them for a period of time that could be years is known as long-term investing. Warren Buffett, a multi-billionaire investor, is renowned for using the value investing technique, in which he evaluates a company's fundamentals, its assets, liabilities, and actual book value before investing in those he believes are cheap. It is clear that he has benefited much from this. However, for most individuals, short-term investing is holding on to shares for as little as one day before selling them. However, the time, frustration, and work needed to regularly get a return on your investments are just not worth it because this is too hazardous and easy to lose money. The majority of us desire to be able to make passive investments, which are those that don't demand a lot of time and effort to manage them optimally. For some folks, we want to be able to set it and forget it. Even the thought of conducting company research sounds like more work than we'd like to put into indexes. Indexes track the performance of specific stocks and typically provide insight into the state of the stock market as a whole. For instance, you may be familiar with the Dow Jones Industrial Average, also known as the Dow Jones or just the Dow. This index monitors the stock performance of the top 30 American corporations listed on the stock exchange. You may be familiar with the Standard & Poor's 500, also referred to as the S&P 500. This index monitors the stock performance of the top 500 US listed corporations. The top 100 UK companies listed on the exchange are tracked by the FTSE 100 in the UK. These indexes serve as a tool to help us understand how the stock market is performing generally, but what if you had access to a fund that held all of these businesses? Here's where exchange-traded funds, ETFs, also known as index funds, come into play. Both share many similarities and only a few minor differences. For instance, you can invest in the Vanguard S&P 500 ETF, just like you would a regular stock because it holds all the companies included in the S&P 500 index. To put it another way, you can visit your broker and buy one share of the Vanguard S&P 500 ETF, thereby dividing your funds among the 500 companies that the S&P 500 index tracks. An ETF like the Vanguard S&P 500 does this for you so that it appears as though you are invested in just one stock, but is actually a basket of other stocks. This single fund acts as a way to diversify your investments without actually having to go out of your way to invest and manage shares in 500 different companies. The best part is that the S&P 500 ETF automatically includes new companies that are added to the S&P 500 index without your intervention. If you're trying to invest for the long term, you'll frequently hear personal finance authors or YouTubers recommend investing in ETFs like the S&P 500 because they are a relatively safe and passive option. But how much money can you really anticipate making from the stock market? In actuality, a bull market has existed since 2009. In a bull market, prices and share prices tend to rise as opposed to a bear market, where prices and share prices tend to decline. As a result, we're noticing that an increasing number of investors anticipate their portfolio, a fancy way of describing the stocks they own, to generate returns that are higher than average. The average annual return on your investment of 6 to 10% is considered good, even though it may not sound as flashy or extravagant as one might expect. Keep in mind, however, that for the average retail investor, the stock market shouldn't be viewed as a means of making a lot of money quickly. With the popularity of apps like Robinhood or Webull and others that make trading in the stock market more and more accessible, retail investors frequently invest into the stock market without doing their due diligence or a slither of research, so be warned. For the long-term investor, it's very much a game of patience and investing in your portfolio month by month. But be warned, you will encounter people promising you high returns on your money everywhere. 1. The idiom, buy the dip, is one you'll hear a lot. And as frustrating as it is to hear it, it's vital to realize that investing can be greatly influenced by our emotions. When we see the price of a stock rise, our fear of missing out may set in, and we can wind up making a disastrous deal. In reality, the ideal moment to invest is typically when we observe a share's price decline. Where the money is made is in the dip. 2. Only invest money that you can lose. A typical piece of advice is to put about 10% of your income into investments each month. For me, this usually means investing in the Vanguard S&P 500 ETF that we previously discussed, but it's money that I'm prepared to set aside and leave for a very long time. We're talking about a time period of 15 to 20 years from now. 3. Refrain from selling your shares as soon as you see a decline in value. In the long run, you never lose money on a trade until you've actually sold the shares that you've acquired. So if your portfolio is sufficiently diversified, this shouldn't matter. If you're investing for the long term, you should expect to see some peaks and troughs. 4. Avoid embracing the next big thing. Make a plan and stick to it. Although they must move quickly, successful traders do not need to think quickly. Why? Because they have the discipline to stick to their trading plan and a predetermined trading strategy. Instead of attempting to chase earnings, it's crucial to firmly adhere to your recipe. Don't let your feelings overpower you and cause you to change your tactics. Recall the day trader's credo, plan your trade, trade your plan. 5. Ignore penny stocks. You're undoubtedly searching for bargains and inexpensive costs, but avoid penny stocks. These equities are frequently illiquid, and your prospects of striking it rich with them are frequently slim. This video focuses a lot more on solidifying your knowledge of the stock market. If you liked the video, please hit the like button, subscribe to the channel, and enable the notification bell if you're eager to see more intriguing topics. We assure you that we will keep uploading videos for the betterment and knowledge of our audience. Peace and blessings to you all from our family to yours.